Let me say by way of introduction, just remind you a little bit what all of you know and what you read in the paper, and just put it in a little bit of a framework, and that is to lean back and saying, what's happening in international financial market? What does globalization really mean? It of course all starts with technological change, especially in data processing and communications. I don't know what we used to do without email, but nowadays we're so reliant on it that whenever I don't take my computer on a trip, I have withdrawal symptoms after a day or two. And the things become very difficult very quickly. So I carry it along in spite of all the problems that you have. Now, this increase in communication has led to a process which is called globalization, which many people talk about. But in the financial markets, it means something quite specifically. It means that basically we see slowly but surely the beginning of the dissolution of things that we have taught and learned. For example, if I wanted to have a, let's say, Australian dollar deposit, in the old days, I had to go to Australia and deal with the Australian banks and the Australian regulations. Nowadays, as you know, I can have an Australian dollar deposit right here in Singapore in a Canadian bank. In other words, I can split the regulatory system, I can split the institution, I can do business with whoever I want to, and I have to make a choice among a wide variety of currencies, which is becoming, in an internationalized world, ever more important. Obviously, this globalization has, on one hand, has been led by liberalization, but it also drives liberalization. We see it now, particularly in the region, where just yesterday the Philippines announced liberalizations. Why? Because in a globalized market, investors put money into the Philippines. The peso has gone up a little bit faster than the central bank thinks it should go, and therefore they're essentially forced to allow residents of the Philippines to be more liberal in taking their money out. There's of course also a considerable amount of deregulation. I now receive funny forms from banks with whom I had accounts for 20 years and longer, who ask me, is your first name, are you related to anybody with a first name called Osama? What is your income about, etc., etc. There is a considerable amount of re-regulation, and all my banking friends tell me that they have to spend a lot of money now on compliance. And on the boards where I serve, actually I serve on 4 companies in Canada and 2 in the US on the board, we obviously are more and more interested in making sure that we are complying with all the regulations, and that requires some effort and some expense. Now, the liberalization and globalization of financial markets has led to a tremendous amount of securitization or financial innovation in general. Basically what we have learned here is to take a financial contract and look at it very closely. And this is one of the areas, usually, I must confess, academia is limping behind the practitioners. But financial innovation and financial engineering are one of the areas where we were leading on the academic side, and the practitioners were then following. I was at Stanford, actually, when the famous option pricing model by Black-Scholes was developed. And I must confess I didn't understand, well, I understood it ultimately after reading the article 4 or 5 times, but I did not understand and comprehend completely the implications, which, I mean, options have been traded in the 16th century on rice prices in Osaka, where they're a good thing, or in Holland on tulips. But nevertheless, this was the first attempt, and successful, to formulate an important economic principle and ultimately be able to put it on a computer and price these things much finer. And this financial engineering phenomenon, basically, although we can have a weeks-long discussion here, and sometimes I do a long seminar on financial innovation for banks, but basically what it boils down to is that we have learned to look at financial contracts and break them down in their individual components. If you just take a simple loan, a loan consists of the commitment to advance the funds. It reflects the currency. It reflects a future, namely the interest rate commitment. Well, let's take this as an example. Simply, what are we doing with interest when I have a fixed rate loan? What do we do today with the interest rate commitment? Well, we have stripped it out and we trade it on the exchange, called an interest rate future, on the London Stock Exchange, the Singapore Stock Exchange, the Chicago exchanges, where we trade interest rate futures, which are only bets on interest rates. So you can buy today, I don't know what they charge in Singapore, but in the US I can get $1 million interest rate future and take a bet on where the 3 months LIBOR rate, the interest rate, is going to be in 10 years from now. I can buy that commitment. That's the only commitment. I have no credit risk, I have no loan, I have no cash floating around. I have only a contract that says we bet that the interest rate in 10 years, the 3 months interest rate 10 years from now is going to be 6.18, and if it is higher, then we will pay you. If it is lower, you pay us. This is a tremendous improvement, because nowadays I can focus, or there are people who focus only on that aspect. And as we will see, for the individual, it has stripped down to the individual investor. In many cases to create value, but in many cases also to fool people. And I'll use a few examples probably as out from that I see in the Singapore market as we go along. This securitization is tremendous. It also involves, of course, packaging securities. I'm on the board of a little financial institution called General Motors Acceptance Corporation, GMAC, and or some of their subsidiaries to be precise. I'm not on the big board. But what we do essentially, we package normal car loans. We take the car loans, bundle them in large sizes, so they're interesting to pension funds and large institutions. But we also transform them in the process. For example, we enhance the credit by saying, we'll take the first 8% of the losses, or somebody else takes the first 8% of the losses, which for car loans is quite high, because historically the biggest loss ratio of car loans during a bad recession in the US has been about 6-7%. People are very reluctant to give up their cars, or if they give up their cars, you get still value out of it because you can buy it. So the other thing, of course, that we do is, in order to make these securities acceptable and of interest, for example, to banks who don't like fixed assets on their asset side because they do normally have floating rate deposits to fund themselves, we put a swap on those, and that makes these car loans, which are typically fixed rate, make them floating rate, and so acceptable. So here, by taking several elements from financial contracts together and packaging them so they fit a particular clientele, we can create value and make these illiquid car loans very liquid. They can be traded, and people who put emphasis on liquidity, people who have, for example, casualty insurance companies who may be suddenly hit with a hurricane or some earthquake or whatever, they suddenly need liquidity, and for them liquidity, the ability to sell these securities very quickly, is very important. Car loans are very difficult to sell.